Welcome to Business Talk. Now, if you've ever looked at a trading screen and felt a little bit like you've needed a translator, you're certainly not the only one. I think the problem with the world of investing is that it's filled with too many TLAs, as I call them, three-letter acronyms, terminology that can feel unnecessarily complex, bid-ask spreads, limit orders, long versus short positions. And I think it can sound a lot less like finance and a whole lot more like a very foreign language to most investors. And the risk, I think, is that the jargon both confuses and intimidates people. And frankly, it keeps people on the sidelines. And that's not good. We want more people investing. So we want to strip it back because investing is actually quite simple. You're buying a piece of a business and hopefully over time that business grows. So today we're going back to basics amid all the market turmoil and everything that's going in the Middle East. Park that for a moment and we're going to unpack the language of the market with our market sage, our market guru, as always, when we're talking things investing in markets, Wendy Myers, head of PSG Securities. Wendy, good to have you with us.
Thank you. Thank you, Michael. So I'm so glad you mentioned that. I mean, to me, investing is simple. I mean, obviously, I've done it my entire life. But I agree with you. I think people are intimidated by some of the acronyms that they face. And so that stops them from investing. And I hope from what we discussed today, it makes people realize it's really not that complex. I mean, to me, I love to take things back to basics. So when you think of investing, just think of buying a single unit of ownership when you buy a share. And that's your single unit that you own of a company that's listed on the exchange. And if you look at an exchange and you say to yourself, well, what is the simplest form of an exchange? It's really a market. It's bringing buyers and sellers together to agree a price. So, I mean, that's really the basic concept of it. And you know what I find so fascinating? Because if you're interested in investing, I mean, I would imagine you're also interested in the history of it. But, you know, the first official stock exchange, which I only realized when I was reading up on it the other day, it was established in Amsterdam in 1602 by the Dutch East India Company, which I think that's fascinating. And it was created to trade companies, to trade shares and bonds. I didn't realize they had bonds then, but there you go. And the first electronic exchange, which I think this is more exciting for me because, you know, everything's digital now, was the NASDAQ. And the NASDAQ was established in 1971. And the person or the two brothers that were responsible for delivering that or contributing to the NASDAQ's creation, I don't know if you remember Bernie Madoff and his brother Peter. So Bernie Madoff's infamous. There you go. I mean, he perpetrated the largest financial fraud in history. I think his Ponzi scheme was over 20 years, with $64 billion, of which about 18 billion was lost by his victims. But anyway, what he and his brother did, they actually developed the automated quotation system. And that is still in use by the NASDAQ today, which I think is pretty amazing. Anyway, but let's delve into what some of the terms you were talking about just now, Michael. And I think, you know, you're so right. When you go onto your screen and you start to look at the shares that you want to invest in, you start to see this concept of a bid and an ask price, and you start hearing things like a bid offer spread, or bid ask spread. So let's unpack, like, you know, with the basics of what that is. So an ask is effectively the buying price. So the ask price is the lowest price a seller is willing to accept for their asset. And this is the price you pay as the investor when you buy. The bid is the highest price a buyer is willing to pay for an asset. And this is the price that you receive when you sell. And the difference between the two, the ask price is always higher than the bid price. And the difference between is the spread. And to cut things into even more basic terms, if you have a very narrow spread in a stock, that means the stock is highly liquid. So, for example, like an Apple stock. But if you have a very wide spread, that is then suggesting very illiquid stock, right? And it's obviously those small caps, exactly. So I think when entering a limit order to buy or sell, you need to understand the bid-ask spread because it's critical when you're using limit orders to make sure it matches.
Now, if you're already seeing that even something as simple as where you place your order can impact your return and something like a bid-ask spread, I think this is really where it gets quite practical because once you understand bid and ask. I think the next decision is then how you trade, the market order versus limit order. What's the key difference between the two? And I think anyone who's gone onto a share trading app or platform, be it on their bank, would see, do you want it at market or do you want it at limit? And you think, oh, what does that mean? I mean, well, what's the difference between the two?
Yeah, my personal way of investing is always using a limit order, but both market and limit orders have their place. I think a market order we would always use, especially if you want a quick exit. So understanding when to use limit or market is critical. So a market order will prioritize speed of execution. But if you want to control your price of entry, then you would use a limit order. And choosing the wrong type, you need to be mindful that it can certainly lead to higher than expected costs when you trade, or even unfulfilled orders. So be mindful of it, but let's unpack what the difference is. So a limit order is an order to buy or sell a stock with a restriction on the price to be paid or the price to be received. This gives you control over the price, and this is why I like it, rather than just taking what's available. And to keep costs low, trade liquid assets during obviously normal market hours. Most platforms don't really allow you to trade outside of normal market hours, but this is just for noting. And then use limit orders rather than market to avoid paying more than necessary. What I find a lot of platforms do, because a limit order gives liquidity to that exchange, they actually give you very good entry levels. Whereas market orders, because you're effectively taking liquidity away, you end up paying a premium. So in basic terms, a market order is an order to buy or sell immediately at the best available price. So buying with a market order hits at the higher ask, whereas selling hits the lower bid. And sometimes I find platforms actually add an additional spread to that. So the amount that you get is less than you expect when you sell. And these types of orders, as I've said, they take liquidity away from the market. So just be mindful of that, but they're very useful when you want a quick exit. And that's an important distinction between the two order types. Then another factor to consider is the concept of when you trade in a share, is it trading cum the dividend or ex the dividend? Now it sounds like Latin, but it's really very basic. When a share is trading cum, it means it's trading at a higher price because you are entitled to the dividend. And when the dividend gets paid out, you'll receive it. So there's a premium on that. When a share is trading ex-dividend, it generally, obviously, means you're not going to receive the dividend. And where a share is trading higher because it's cum dividend, the minute you receive the dividend, the share price tends to drop. So you need to understand that when you're trading in shares. So it's important to understand the next dividend payout date when you do buy. And then just remember that the platform you choose to trade on is required to make available a contract note. Either they'll email it to you or they'll publish it on the platform. But this is effectively the official document provided by your broker detailing the transaction. It details the execution price, it details the fees, and this document represents your record of ownership of the share. So if ever there's a question about the cost of entry for that particular share, this is the document that you would show. And then just to sort of finish off on trading, I think it's important to also understand the use of a stop loss order or a take profit order. It's also a way of trading where you can, certainly in a stop loss order way, you can close a position at a particular price that might help you limit some potential losses. Or take profit is I've reached my 30% up and I want to realize it, so I take that profit level. So those are quite funky tools to either limit your losses or to make sure that you realize that profit for your longer term goals.
And it imposes some kind of discipline and to ensure that if you are trading, that you go in with a strategy. And I think that the difficulty so often is, when you're on a good thing and you're on a winner, when to sell. And maybe you've gone up 20, 30. In the case of precious metals, a lot of people would have gone up 100%. And you think, I want to lock in those gains because you might have seen what happened to precious metals recently with the war in the Middle East. PGMs came all the way back down, and maybe if you had that in place, you would have locked in those gains closer to the top, depending on what your strategy is. But again, I think what you've highlighted, Wendy, is that so often when it comes to this, timing matters. Timing matters in terms of your speed of execution, and it's important to understand the mechanics, and it can really prevent costly misunderstandings for your investment at the end of the day. Let's just shift gears slightly, because we often hear investors say they're long the market or they're short a stock. What does that actually mean?
Yeah, so it's a very common term used by analysts, investors, market makers to refer to a long or short position when speaking about stocks, but it's most often used when you're talking derivatives. But in its basic form, it applies to shares. So long and short positions are fundamental in investing, and it effectively refers to two different ways, two different approaches to capitalizing on price movements. And that's an important concept. So a long position refers to the purchase of a share, and you're expecting that the market will appreciate in value over time. So going long is the same as being bullish. And effectively, the investor is aiming to realize a profit over the long term by selling that asset at a higher price. Short positions are something that a lot of investors tend not to look at. They're more complex. I do agree with that they're more complex and they are more risky, but it's actually a good hedging mechanism. It's important for investors to understand it's available to them, and it involves selling a borrowed asset. And there, your anticipation is that the price will go down. So, I mean, if you think, Michael, all the volatility now, if somebody had gone short overseas and even locally with our commodity prices, they'd be looking at very healthy returns at the moment. The investor will then later repurchase that asset, because they've obviously got to deliver on their short obligation, and they will repurchase it at a cheaper rate. And then they'll profit from that price difference. This is the same as being bearish on the market, because you've got a negative view of stock performance. And as I've said, it's highly speculative. Shorting the market for a specific share can certainly help the investor reduce overall portfolio performance and mitigate risk, and can offset some losses, especially during a market downturn. So it's something that a lot of investors don't consider. But I think it is certainly something that can be very effective in assisting you in managing your returns.
And often when I chat to fund managers who are managing portfolios for institutional clients, big pension funds, they use this kind of strategy to smooth volatility as well, because it allows you to profit when markets sell off and when markets go up, sometimes through momentum. But when you have an event like a black swan like this, it'll just smooth that return over time. And depending on your risk tolerance, I mean, that smoothing might be the exact kind of ride you want. Maybe, to use an analogy, if you're in a Land Cruiser, you don't mind the old hard-sprung, very rough ride and you can stomach it. You might want to go put new shocks in and make that ride a bit smoother so that you can sleep better at night. And really, I think it's a great tool for that. It is a little bit more sophisticated, but I think really important for retail investors to understand that they've got that in their toolbox. Now, I mean, you mentioned the NASDAQ and only developed back in the 70s, and a fascinating history that the first exchange was in the 1600s. I was not aware of that, but it's really fascinating that even through all of this change, a lot of things have pretty much stayed the same. And this is a really interesting one, and I think something many South Africans may not even realize applies to them. There are still investors holding physical share certificates, even though when we think of trading nowadays, it's mostly done on our smartphones or on our laptops. Why is it so important to convert or dematerialize, as they say, those shares?
Well, I think what's amazing for me since I joined PSG, Michael, we have a constant volume of clients bringing physical scrip or rematerialized scrip to us for dematerializing, which is fantastic. But the point is, it still exists, and I think a lot of investors don't understand what to do when when they find the scrip in their garage or under the mattress. But it's more common than you think. And for me, I want investors to, and this is a personal thing for me, because I've had friends of mine who've got parents that have got these physical scrip and they don't know how to address it. So it's important for investors to understand there is the need to take those physical pieces of paper to your registered stockbroker. I think the whole concept of going digital was driven by the JSE. They went electronic in 1996, which, as you say, compared to the NASDAQ in 71 is quite a big time difference. But the JSE has been, since that time, since 96, focused on converting these physical certificates to electronic records. And the biggest reason is liquidity. Obviously, the more your shares are traded on the exchange as an issuer, the more liquid it is. But there's benefits to the clients too. For me, if I've got a physical scrip, I'm not getting the dividend. And there's a potential that physical scrip can get lost, can get stolen. And so you want to have it secure, and you want to have it on a platform where it's held in safe custody, because once it's there, you're able to then receive your dividends. You can go onto your online platform and you can monitor your share price movements. Obviously, it's faster settlement because it's all digital. So it's a key item for those investors who do still have physical certificates or know of people that do, to really encourage them to open an account with a securities firm, get it into digital format, known as dematerializing. But please know, there's a cost to it. It might be 500 Rand per script, but that's immaterial in the when you think of the long-term benefits. And I have heard of instances where you get sharks out there and they start to try and spin these stories about what they need to do to help convert it to digital form, and they list some outrageous fees. So it's very much the investor must know it's business as usual for any registered stockbroking firm, and they'll be able to assist you in getting it to digital format. And then I encourage you to start trading and investing more than having something on a piece of paper in your garage or under your mattress.
Absolutely. But I think what we're doing is helping people to get into the market because, as you say, there could be sharks out there, and there are often, but that is because there's this asymmetry of power, and that is based on information, knowledge. When people don't know what things mean, dematerialized, cum, ex-dividend, bid, ask, spread, all of those kinds of things that we've unpacked, you feel intimidated. And I think what you've helped us today immensely with, Wendy, is just demystifying that. It doesn't have to be intimidating. Obviously, the terminology can seem overwhelming, but when you understand just a little bit, it can give you a lot more comfort to go out there. And I think the biggest risk of all is not taking one at the end of the day. So Wendy Myers, thank you very much, head of PSG Securities. That's all from me from Business Talk today. I hope it simplified some of the investment jargon so that you can take that plunge. Don't be intimidated by the world of investing. And if you've got any more questions or anything you want to chat about when it comes to the world of trading and investing, reach out to PSG Securities and tell them Michael sent you. Take care.